Okay, is this working? Wonderful. So good afternoon and welcome to the session 1 of this conference. This is the first time that we experiment with this hybrid system, so let's hope that everything goes smoothly. The session is going to last for 2 hours. There are 3 papers, so we have 40 minutes per paper, and the division of the time is 20 minutes for the presentation, 10 minutes for the discussion, and 10 minutes for general discussion. The 3 papers in this session are all related to the impact of COVID-19 on banks. One of them, the first one, looks at different effects on banks with high and low credit line portfolios. The second paper is about standardized versus IRB banks and the differential effects of COVID. And the third paper is buffer constrained versus buffer unconstrained banks. So we're going to learn, I guess, a lot about these different dimensions of heterogeneity among the banking system. So without further ado, we have the first speaker, Camelia Minoiu from the Federal Reserve Board online. Let's hope that she can start her presentation. Camelia, you're there, you are online. Wonderful.
Absolutely.
So you can welcome and you can get started.
Thank you so much. Good morning and good afternoon. Thank you to the organizers for including our papers on the program. It's an honor and looking forward to a very smooth technical occurrence here. So the paper I will present today is about liquidity insurance and credit provision by the banking sector. And the evidence will be from the COVID crisis. This paper is joined with Tümer Kapan from the IMF, so we have a disclaimer that these are our views. So let's travel back in time to March, April 2020, when firms were facing significant cash pressures as their revenues were plummeting amid lockdowns and other economic disruptions. So this is the spring of the COVID crisis as it unfolded globally and was entering into the US. At that time, as firms were experiencing these revenue disruptions and cash pressures, they approached their corporate lenders to draw down on their credit lines. And the system as a whole in the US had about $1 trillion worth of corporate credit lines outstanding, much more if we include other types of borrowers. What's important is that these credit line drawdowns were very large by historical standards, and they exceeded GFC levels quite significantly. On the left-hand side, we see a chart where estimates suggest that for public firms only, about $350 billion of credit lines were drawn down. And we can see that this episode is extremely concentrated. So it is short, and the surge is occurring literally over a few weeks. In the chart on the right, we try to compare this tsunami of credit lines with what happened during the global financial crisis. So we're showing C&I loans, commercial and industrial loan balances for the whole banking system normalized on the week of the shock event, which is for COVID, the declaration of national health emergency, and for the GFC, we take the Lehman failure. And what we see here in magenta color is that C&I loan balances for the banking sector as a whole were increasing much faster and much more than they did during the global financial crisis. So the shock was larger and more concentrated. So what do we notice at this very same time? We see that banks met these drawdowns. Even anecdotally, there is no evidence that banks failed to meet their obligations or that they invoked covenant violations to not disperse credit lines. So they seem to have very successfully fulfilled their liquidity insurance function. And again, this is different from the GFC, where there's quite some literature showing that oftentimes banks refused to, because they were in poorer financial health, they refused to honor their obligations. But at the same time, during this crisis, we noticed that bank credit did decline. Originations of new loans and renewals of new loans were extremely weak in the quarters subsequent to this credit line drawdown event. And we see that on the left, just illustrating with data from the syndicated loan market. And on the right, we see the same just by looking at the Senior Loan Officer Opinion Survey, which tells us how many banks or what is the likelihood that banks tighten the lending standards to firms. And we see that in the April survey, so this is the Q1 survey, the share of banks tightening jumped up to levels not seen since the GFC. So banks tightened lending standards significantly and originated much less than before. They were very reluctant to lend. So we tried to bring together these two patterns and ask, is it possible that credit line drawdown risk may have made banks more cautious in their lending decisions? And if so, what are the channels? The first most natural channel is that credit line drawdowns impose a liquidity drain. That is that loans need to be funded, and so the banks have to have liquidity on hand. Secondly, credit line drawdowns are extremely capital intensive. They, once a drawdown takes effect, the exposure, when it moves from off balance sheet to on balance sheet, for short-term credit lines is 5 times more capital expensive than when it sits off balance sheet. And in addition, banks were seeing that their balance sheet size increased, so that puts pressure on the leverage ratio. So both regulatory and simple unweighted leverage ratio or capital ratio, both of them were under pressure. In addition, it can happen that weaker borrowers approach their banks. We saw that during the GFC. And if that happens, then the makeup, the risk makeup of your loan portfolio changes as the drawdowns happen. And finally, even if the bank is extremely strong, it goes into the crisis with high liquidity and high capital. It's not cut off from funding markets, and it's able to absorb this shock. There is still the potential for future losses because all of a sudden it has exposures that before were off balance sheet. And so that may make the bank more risk averse, independent of its financial health. So we are going to ask, what is the impact of credit line exposures as a proxy for exposed credit line drawdowns on banks' lending decisions? And we're going to look at extensive and intensive margin of loan adjustment and try to dig into the mechanisms as well. Now, of course, we experience many identification challenges. The most important one is that it's hard to come up with exogenous variation in credit line exposures. How many credit lines to extend is a bank decision, endogenous to its characteristics and lending opportunities. So to alleviate this problem to some extent, we use ex-ante pre-pandemic credit line exposures, independent of the recessionary dynamics that occurred during the crisis. And we show that these are strongly correlated with actual drawdowns, but we're not going to use the drawdowns themselves. Importantly, we need to separate credit demand from credit supply effects, and depending on the granularity of our data set, and we're going to throw a lot of data at this question, we're going to try to be as careful as possible using the Poisson-Yam setup, and then, stress test that setup as much as we can in our regressions. And we are going to present a portfolio of evidence. We're going to run through a number of data sets, of which I will select a couple to show in this presentation, trying to convince you that regardless of the sample of banks we look at and the granularity of the data, the patterns are extremely strong. So we carry out in the paper 4 analyses. We look at syndicated loans globally. So we have a global bank analysis. Then we go to small business lending data from the credit registry of the US. Then we look at survey-based data from the US Bank Loan Officer Survey. And finally, we use data from the Paycheck Protection Program, which was a huge grant-making program deployed at the height of the crisis to support small businesses in the US. I'm going to focus, in the interest of time, on 2 of these analyses. Okay. So, as I mentioned, credit line exposure will be our main measure of exposure or source of heterogeneity across banks. The way we compute them is to start with the deal scan sample from representing loans in the syndicated loan market. So these are large corporate loans. And we see originations in deal scan. For every single bank, we are going to compute the amount of credit lines that the bank had originated and were sort of ripe for being drawn down. So they were outstanding as of end March 2020. In the chart on the right, we show the correlation in the call report, not in deal scan, in the call report between initial CLEs and the exposed drawdowns. And we see that this correlation is very strong. We don't do this in deal scan because in deal scan, we do not observe credit line drawdowns. And for the rest of the analysis, we stick with this measure because we want to have consistency of the measure across data sets. There's a lot of heterogeneity in credit line exposures across banks globally. The typical exposure is 8% for GSIBs, 15% for US banks, less than 1% for Chinese banks. A lot of heterogeneity. And so this is the first piece of evidence I want to show, illustrating the negative correlation between ex-ante credit line exposures, as I mentioned, strongly correlated with exposed drawdowns, and banks' lending decisions subsequent to the tsunami of credit line drawdowns. So here we're correlating ex-ante CLEs with loan growth in 2020 Q2 and Q3 compared to any time in 2019. The data is at the bank firm cluster level, where a firm cluster is given by all firms in the same country and industry. And these correlations are quite strong and significant, suggesting that higher CLEs are associated with a lower growth rate of lending subsequently, so after the credit line drawdown episode. The coefficients are also economically significant. In deal scan, we can also examine the extensive margin of lending, not just the intensive margin. And by examining individual bank firm lending or borrowing relationships, we find that the probability of loan renewal for loans that were maturing in the second quarter of 2020 was lower for those banks with higher CLEs. Similarly, banks were reluctant to renew a credit line that was falling due with another credit line at the same time. And that's seen here in the coefficients that are largely negative in this table. And more generally, our deal scan results are driven by US banks, and they're much stronger in general for GSIBs because these banks are the largest participants in the market. So let me now go to the SLOOS results, which are the survey-based results from using data from the Federal Reserve. And from the outset, let me say that this survey is used for monetary policy purposes, not for financial stability or for supervisory purposes, which means that banks are incentivized to tell the truth. For instance, if they experience capital constraints, we trust those numbers. And we see that those numbers are trustworthy by comparing times of financial stress with times of across crises, and we see that banks truthfully report if they feel balance sheet constrained or if they feel like their risk aversion has increased. So using data from the Senior Loan Officer Opinion Survey, we can correlate the propensity that banks said they would tighten lending standards to small firms or to large firms, these are the top and bottom panels here, with their ex-ante CLEs. And we see, looking at the top panel, we see a strong positive correlation between ex-ante CLEs and the probability that banks declared or said that they tightened lending standards to small firms. We also see, moving across columns, that this coefficient is there statistically, but it declines over time, and it sort of disappears by the fourth quarter. So as a background, by the fourth quarter, by the third and fourth quarter, the banks were extremely well provisioned. They had more visibility about the credit quality of their portfolios, about what could happen to, what was happening to forbearance. And so their risk aversion had declined somewhat. They had also issued a lot of equity during the crisis. For instance, the month of May was a record bank issuance month. So it is normal that the effect of the initial shock dissipates over time. We also see that to large firms, more exposed banks tighten lending standards as well, but not as much as to small firms. So this is a bit of a crowding out. This is evidence of a crowding out effect. It's the behavior of large firms that ultimately has consequences on credit availability to small firms. I will use the balance of my time to take you through some suggestive evidence on mechanisms. For mechanisms, we rely again on this survey. And we are going to examine the reasons by which, or invoked by banks, for tightening lending standards. This chart here shows just the raw data, the share of banks that say they tightened in each quarter of the first 3 quarters of 2020 for various reasons. Capital constraints, liquidity constraints, unfavorable economic outlook, so fear that, or concern that NPLs would be hitting the balance sheet, industry-specific problems, typically related to COVID-sensitive industries, lower tolerance for risk, and secondary market liquidity, which is relevant especially for banks trading syndicated credits in the secondary market. What do we see here? We see that the main reasons why banks were tightening were concerns about the economic outlook, industry-specific problems, and lower tolerance for risk. So let's take these responses and correlate them with ex-ante credit line exposure. And when we do that, we obtain the results here. In the first 3 columns, we look at the full period and then in the last 3 by quarter. And we see that credit line exposures were more positively correlated with the banks citing own liquidity position as a reason for tightening. This is absolutely normal. The banks were experiencing liquidity pressures as tens of billions of dollars were being demanded by their corporate clients. We also see that own capital position doesn't seem to matter, or it doesn't matter with the expected sign, and that lower tolerance for risk is extremely correlated with credit line exposure. So more exposed banks were far more likely to cite a lower tolerance for risk, or more risk aversion, quote unquote, for tightening lending standards. And we can decompose this effect over time, and in column 6, we see how it's very sustained over time. Whereas in column 4, the liquidity pressures, we see them dissipate extremely fast. After the first quarter, they go away because the drawdown event had ended, and demand for loans had virtually disappeared once the large corporate clients had open access to the bond market and other funding markets.
Camelia, you have 5 minutes.
So to conclude, in this paper, we try to convince you that banks with higher ex-ante credit line exposures were more likely to curtail the supply of new syndicated loans. We do have identification identification challenges, of which we are very, very open and transparent. But such is economics. They also tightened the standards in terms of new CNI loans, and they, in results not shown here in the discussion, they seem to be a bit more reticent or reluctant to participate even in very low-risk government credit support programs. The main takeaway from a financial stability perspective is that credit line drawdowns didn't pose the systemic risks created by, say, securitized products or reliance on short-term wholesale funding that we saw in the GFC. But yet they had a meaningful impact on banks' financial intermediation, an impact that dissipated over time. Finally, we argue that banks' off-balance sheet credit exposures, which are extremely large for the banking sector as a whole, deserve closer attention. And in particular, we argue that we might want to be looking at the LCR a little bit closer because it seems to have been calibrated with the experience of the GFC. But in reality, credit line drawdown rates that we saw during the COVID crisis were much, much larger than what we saw in the GFC. So looking at the LCR closely may also be, it's also an indication of our results. Thank you, and I look forward to Daniel's comments and questions from the audience.
Okay, well, thank you, Camelia. You stick to the time, so this is going to leave us some further time for discussion. The discussant is Daniel Paravisini from the London School of Economics. We are uploading the presentation, so... Okay, so okay.
Can everybody see it?
Yeah.
Okay, good. Well, first of all, thank you to Banco de España, CEMFI, and Rafa for the invitation to be here. It's always a pleasure. And in general, a pleasure to be here, but particularly a pleasure discussing this very interesting paper. Okay. So the paper has a very important question in financial intermediation, which is whether banks, in the middle of a crisis, where they face a trade-off between providing liquidity insurance to large firms and providing credit to small businesses. The paper, using tons of data, syndicated loan data, regulatory data, survey data, for the US around the COVID shock, it finds two things, in my view, that summarize the paper. First, that before the shock, there's heterogeneity in how much liquidity insurance banks provide to large firms, and it's very much correlated and explained statistically by size. So large banks tend to provide liquidity to large firms. After the shock, those large banks that are more exposed, that provide more liquidity, they tend to provide less credit to small firms than small banks. And the interpretation on the paper is that the credit line drawdowns put liquidity pressure on the balance sheet of the bank, which causes the decline in lending. The facts are well documented, the data is comprehensive, the story is compelling and plausible, so kudos to the authors for putting together an interesting paper. I'm going to what I'm going to do in this discussion is tell you a different story for a trade-off between insurance provision to large firms and liquidity and credit provision to small businesses. And it's based on an old literature in finance, it's based on technology. It's based on the idea that this trade-off occurs early on, the trade-off doesn't occur when the bank faces a liquidity shortage. It happens way early when it's choosing its organizational form, its incentives, its size, etc. And it's based, the theory that better summarizes this argument is Stein 2002. And the idea there is the following. Lending to small businesses requires information that's difficult to communicate. Think about the character of the business owner. That's something that's difficult to put into a number. And because of that, centralizing loan decisions to small businesses is very difficult to do. On top of that, if you have the problem that the agency cost of decentralizing decision-making for loans increases sharply for large organizations, you have the conclusion that organizations are geared towards lending to small businesses have to have a particular shape, if you want, a particular size, particular incentive scheme, particular hierarchical structure, etc. On the other hand, large business lending, and in particular provision of liquidity to large businesses, benefits from economies of scale, diversification, and all the usual economies of scale argument work for that, which means that the trade-off then comes early on when the bank has to decide how to structure itself in order to provide a certain type of service, because it's incompatible to provide small business lending and large business liquidity to large businesses. You have to do a choice. And then the technology the bank chooses, the organizational design, incentives, etc., are either geared towards providing business loans, small business loans, or to providing liquidity to large businesses. Okay? So what are the implications of this type of theory? Well, in quiet times, you're going to have a somewhat segmented market where banks that are good at providing liquidity to large firms are the worst at providing small business lending, and vice versa. And then the question is, how do you measure this technology? Maybe sometimes people use size. It's not a great measure for this, but in a sense, using the context of this paper, by revealed preference, if you look at banks that have a very high credit line exposure, in quiet times, you might think, well, these are the banks that have their technology, size, etc., geared towards providing liquidity to large firms, and are bad at small business lending. So this is a theory that, in a sense, provides you already an interpretation for why there's heterogeneity in this credit line exposure to begin with. Now, what happens? The interesting thing comes when the shock hits, when COVID shock hits. On the liquidity side, it's very clear. Well, just firms to demand more liquidity. Large firms are going to draw down credit lines from the high CLE banks more, because those are the ones that provide the insurance to begin with. On the small business lending side, that's where kind of even more interesting things are happening, because what happens during COVID, imagine you're a large bank providing credit to small businesses. Your systems are based, suppose you're using hard data like current account turnover, and suddenly current account turnover drops to 0 for all the firms. How do you make the lending decisions as a large bank? The alternative is, well, the alternative is to try to wing it by just lending without using any information. The other option is just to stop lending, okay? While small banks that have the technology, you have to go and visit the firm, see whether there's any chance they're going to they're going to survive, being shut down for a couple of months, 3 months, or whatever the expectation was. The small banks, the banks that have the right technology, are able to expand lending in this setting. So put together the two pieces of this theory, and it explains why banks are heterogeneous in credit line exposure, explains why credit line exposure is negatively correlated to lending to small businesses during the crisis. This theory it's consistent with every finding in the paper. The large banks, to call it shortly for high credit line exposure, are going to face higher credit line drawdowns. They're going to lend less to small firms when the crisis hit. They're going to have fewer PPP small loans, and they're going to tighten lending standards, or because they have the wrong technology to lend during this crisis. Okay? And now my comment on the econometric. Is this story distinguishable from the liquidity story? I think it's extremely hard to distinguish. Why? Because first, the right-hand side variable that's used to proxy exposure to drawdowns, it's exactly the same variable that, in my view, is the best measure of what technology the bank chose to develop before the crisis, right? So your right-hand side variable, it's inherently confounding the two stories. Then controlling for observables, you can control for a 12-degree polynomial of size, but it remains the fact that credit line exposure is a better measure of the technology the bank chose than size. So it's trying to control for stuff when your right-hand side variable is by revealed preference the best possible measure is doomed to failure at the onset. And then we go back to kind of the classic approach now, which is the Kwajamian within-firm approach. And even the story I just told you, it should sound to you that this within-firm comparison doesn't work. Why doesn't it work? Well, you have two banks lending to the same firm. One has the wrong technology, one has the right technology, and suddenly moral hazard goes crazy, the wrong technology doesn't work anymore. Well, the large bank with the wrong technology is going to stop lending, the small bank with the right technology is going to continue lending, and you're going to see a shift. And it has nothing to do with controlling for demand. It's just that the underlying technologies of the banks are different, and that explains why there's a shift in lending. So it's a very difficult problem to face if you want to distinguish between the two. But in a sense, from one perspective, the story is also a story about trade-offs. It's a story about a trade-off between providing liquidity and lending to small businesses during bad times. So it is still a story about a trade-off. It's just that the underlying economics are different, and because the underlying economics are different, the policy implications are different. If the liquidity story is right, then providing liquidity to large banks, to high credit line exposure banks during COVID would expand lending to small firms. While if the technology segmentation story is right, that will do absolutely nothing for expanding credit to small businesses. And if you want to make normative conclusions from these results, you have to tell these stories apart, and I think it's a very difficult task to do empirically. So extremely nice empirical documentation of this negative association, this trade-off between providing liquidity and to large businesses and small business lending. I think that the making normative conclusions out of the results would be still a bit too risky. Thank you very much.
Okay, Daniel, thank you. And I would like to go back to Camelia to see if she wants to quickly respond to this discussion, and in particular this alternative mechanism that Daniel has just put forward. Yep.
Absolutely. Thank you so much, Daniel. Really appreciate your comments and raising concerns about this alternative story. As you said, I think the story is not incompatible with, it's perfectly compatible, in other words, with the empirical patterns we identify here. It may be what's sort of lurking in the dark and explaining part of the story. I would maybe very gently push back a little bit against the idea that we have perfect segmentation in the bank loan market. One reason is that if we look at some of the large banks, they're extremely well diversified. They do both large and small business lending. In fact, case in point, the bank with the largest credit line exposures in the deal scan sample is Wells Fargo, very, very big small business lender. And then we have banks like Bank of America and Regions and Comerica, extremely large regional banks that support local communities. So I would think that this maybe segmentation is not so clear-cut as to sort perfectly on credit line exposures. And to the extent that it's not, there's still a credit line story behind our results. I'm hoping to maybe alleviate some of your concerns by using a measure of bank specialization. And I'm adding that to our to-do list. And I very much appreciate all your other thoughts. I mean, this is giving us some food for thought in terms of how we basically interpret our results. So thank you for that.
Okay, thank you. We have questions from the floor here. And,
Thanks, Ralph Martensal, Reserve of Chicago. I think actually your PPP results go more in the direction of, as suggested, the liquidity problem, the fact with the PPLF, and as you've shown, the risk doesn't work either because there was no risk in these loans. So why would then these banks not make these loans? One is they don't have good technology. They rely on centralized stuff and they don't know how to send the stuff to the SBA because they haven't done SBA loans before. And that was the main holdup for the largest banks. They were just not SBA lenders, which is the program the PPP relied on. And that made it extremely difficult for them. Having been involved in a startup that tried to do this with Bank of America, I can tell you it was impossible. And I think most of large banks had exactly that problem, that they did not have the technology or the experience in place to funnel that program, which suggests something more along the lines of what Danielle was saying.
okay, Camelia.
Yeah, that's a very, very fair point. I would also add, so this is a hard sort of argument to make because we don't really have data for it, but others suggest that what was holding up the large banks from participating in the PPP was not so much the technology platform, which they set up in place pretty fast, I mean within weeks, but it was more the fact that they wanted all the rules to be sort of written black on white because they're subject to much more regulatory and supervisory pressure. So that some observers comment that this was the main holdup for large banks as opposed to not having been able to deploy the funds. So I think for every story that we tell, there's anecdotal evidence for other stories, but I fully agree with you that these are valid concerns.
Okay, let me remind the online audience that they can send questions and hopefully I will be able to see them in my laptop here. So Elu Fontaden, Elu.
Yes, I think in fact very similar to Ralph, what Ralph was saying. I was puzzled from the start. You were upfront about it, which I thought was very, very good. That at the one hand you had these banks engaging less in the C&E new lending, and on the other hand they were reluctant to take up the PPP and the other government support programs for liquidity. There is an obvious tension between the two, and it would be nice sort of to see your intuitive story about this. There must be more than just a liquidity problem. I mean, for example, of coming back to Randy's talk this morning, maybe there is something like the stigma, so you don't want to use these programs, and the stigma is stronger than the potential lending incentive. But there must be something, because obviously that would be consistent with the technology. I mean, the observed tension between these two observations would be consistent with the kind of Paravisini-Stein technology argument. And so in that sense, there must be something intuitive behind your story, and I would like to see what it is.
Okay.
Absolutely, thank you. Thank you for that comment. So if I may take a second to respond to it. So what we see for the PPP is a negative correlation between ex-ante CLEs and the amounts deployed through the program. And so I think intuitively we're thinking about this result as suggesting that banks with higher CLEs were reluctant to expand their loan books. With just one caveat, the economic effect there is not very large. Why do we think that they were more reluctant to expand their loan books? It's because, also in response to Ralph's comment, there was some credit risk associated with the PPP. So early in the deployment of the program, you may remember the media was sort of all over this program, and there was so much concern about fraud and audit risk. And forgiveness uncertainty. I think the rules and regulations changed like 12 times before they were finalized. So basically, this is about lending under huge amount of uncertainty. Even if the program was a grant-making program and forgiveness was promised down the road, there were still some concerns. In fact, for the MSLP, for instance, some banks mentioned that they were reluctant to participate in the program because they were uncertain about the loss-sharing agreement with the Fed. So there may be soft concerns by the banks that are hard to come up in the data that prevent them from wanting to make them reluctant to take on additional credit risk at the height of a crisis, knowing that off balance sheet they have huge dormant risks that can materialize at any time. So that's kind of intuitively how we think about the story.
Okay, Jan Kranen in the first row here.
Yeah, I have one question only, and it's concerned with your main point. If I understood it properly, there is a channel that you were asking. So which channel can these drawdowns make banks more cautious in lending decisions? So you are looking for that channel. Is that channel really identified in your work? I couldn't really see that, or is this merely that you observe these things happening in parallel? Your liquidity insurance and your credit provision, the two sides of your equation basically, one is old lending decisions, the other one is new lending decisions. And I can imagine that under changing circumstances, new lending decisions differ from old decisions exactly the way you find it empirically. So why need there be a link between these two that can be seen as independent decision processes?
That's a great question. So the way we think about it is that in the data, what we see is that credit line exposed banks are the ones more likely to invoke changes in risk aversion as reasons for changing their lending standards. So if we believe that, let's take the survey data at face value, then what we see is that balance sheet constraints don't seem to matter as much, whereas risk aversion seems to matter a lot. And the way we think about it is that, this risk aversion must come from somewhere. And to your point about lending decisions being correlated over time, it comes from some future capital constraint, future losses that will hit the balance sheet and cause financial, stability problems for the bank. So the risk aversion channel that we identify, we think is linked to these sleeping or dormant off-balance sheet risks that don't materialize during good times. During good times, before the COVID crisis, there was a bonanza of credit line loans. Banks were giving them out like candy. There are, Financial Times articles suggesting that banks were making them part of larger packages of services that they were offering firms, basically giving out credit lines as sweeteners to obtain other business and, make money from fees and commissions on other business. So what we are arguing is that during normal times, these risks are off balance sheet, they don't materialize, and banks kind of don't think about them. But when they are awoken to them, as happened during the COVID crisis, it's a shock that we cannot ignore. It's a shock that even if the banks in the cross-section look very healthy, it will impact eventually their lending decisions exactly during a crisis. So it makes them more vulnerable when we don't want them to be.
Okay, Oren, quick question. And last question.
Okay. Orange Sussman from Oxford. Do you know what happened to trade credit during that period, particularly trade credit from big companies to small companies that supplied it?
That's a really good question. We have not looked at trade credit in particular. I'm sorry, I don't have an insight there. We looked only at corporate credit as a whole.
Okay, so thank you very much. So we have to move now to the second paper in the session. Thank you, Camelia. Thank you, Daniel.
Thank you.
Let me ask the speaker, David, and the discussant to come forward to the podium. And so now we can move to the second paper. Okay, so the slides are already on. So, David, the floor is yours.
Thank you so much. Thank you, Rafa. Thank you to the organizers. Thank you to the Bank of Spain. The usual disclaimer apply. So, pandemic lending. So this paper is also about lending during the crisis. And the motivation, I'm going to spend a bit of time on motivating this paper because I think it's important. So you know that bank lending is procyclical. It's more cyclical than the business cycle, in fact. It's becoming more cyclical than in the past. And probably model-based capital regulation contributes to this cyclicality. Now, Basel II, 30 years ago, that's when the discussion started, was a major change in terms of regulation. And for two reasons, because it introduced the risk-based capital requirements, and then banks could use either a standardized approach using fixed weights, or they could use IRB, which is the risk weights calculated by banks. Right, so a standardized approach versus IRB. If you think of it, this is a massive change, because if you think of banks in the 70s or in the 80s, the focus was about geography, the products that you could offer. Even the fees were regulated, but the focus started to be on bank capital. So if you listen to the two presentations we had, the two policy presentations, were all about banking capital. Is it enough? Is not enough? Etc. Etc. So the focus on bank capital, which used to be a tiny bit of the role of a supervisor for decades. And the second thing, there was a big change in perspective. So the supervisors were in charge of assessing whether a bank was sound. IRB stands behind banks themselves selecting the models of how risky are they going to be in the future. So this is like a Copernican change in the sense that the perspective changed radically. It is banks themselves who have to decide, or in a way model, how risky is going to be in the future. Now, what are the issues with Basel II? The first one is on incentives. We know that the higher the capital, the lower the profit. Equity capital is expensive. But the second thing is a massive change. Like, can we really model the amount of capital that a bank is going to need in all the stages of the world? So Danielson from the LSE put it in much more clear ways, which is like such models, and he's an expert, are useful for measuring risk of frequent small events, but not for unknown unknowns, systematically important events. So the supervisors, they are aware of this, and to smooth the cyclicality, they incorporate through the cycle PDs, and they try to standardize the models. Okay, so what do we do? So this is not a COVID paper. This is, in a way, we are trying to answer a question from 30 years ago, which is whether model-based regulation induced a credit crunch at the time of the crisis. So in a way, it's questioning whether the deregulation on structural and conduct regulation and the massive focus on capital had an impact on the real economic activity. So the setting is the euro area, 2019 to 20 Q3. The shock is COVID. For us, it's interesting because it's an exogenous shock. It's not a financial crisis. There's not the credit cycle goes up, which in a way is endogenous. The data is a confidential supervisory data set, and we use not as many layers as the interesting paper by Camelia had. We use bank level, and then we go to borrower level information because we think both levels are complementary. Let me tell you about our contribution. So there are many papers on lending during crisis. The paper by the classical paper by Ibashina, it's one of them. The one we have seen is another one. Jose Berrospide has an interesting paper. But the key, we focus on lending during an exogenous shock, which is not a financial crisis, which is important for our case. And there is another element, which is the issue of capital requirements and lending, which is an old question in the banking literature. For us, it was important that the binding capital constraint is not linked to a supervisory decision. And now, this paper is closer to an idea that Rafael happens to be sitting next to me, but it's an idea, it's a paper which came up in 2013. I've seen the paper circulating at least 10 years before that, at least since the early 90s. But the thing is that we have evidence already that IRB banks who calculate their own models, we come into this lingo, but in the end it's banks who have somebody, and I can tell you because I talk to supervisors and the people calculating those models, and they have incentives indeed to minimize the amount of capital that they put there. So we have evidence already, there's a good paper by Ben et al., that actually look at the credit charges, the capital credit charges at the individual borrower from IRB and non-IRB banks in normal conditions. Now, the bank perspective is important. Why? Because an IRB bank includes not only credit, but also market, operational, and correlational pools. It's more than one risk. We also look at multiple lending relationships, Kwai and Millan type of work. We wanted to be able to disentangle as much supply shock as possible. We have an international sample, which is nice. We have large exposures, so we are probably underestimating the actual impact. We don't have the SME lending. We could do it with, but we don't do it. We focus on the large exposures. I'm not going to show it in the interest of time, but we also have banks who switch from IRB to standardized and vice versa. Only a few of those, but with enough borrowers to do that. So what do we find? We find that IRB banks indeed reduce lending significantly and with important economic effect, much more than we expected, to non-financial corporations, more than standardized approach banks. So there is cyclicality. IRB banks reduce lending to the same borrower, what Camelia was referring to before, to the intensive margin, which is borrowers to whom you're already lending. Credit was reduced more to those borrowers absorbing more capital. So I'm getting into the story. It is probably because of a capital constraint, which makes sense. And credit was reduced more to borrowers in sectors more affected by the pandemic. So the data, we use supervisory data. Something important is we try to balance the banks we use. So they are relatively large banks. And banks are classified as IRB or standardized approach according to how they measure the corporate credit risk. The borrower level information is from a supervisory data, which includes large exposures around above 300 million or 10% of eligible capital of the bank. So it's relatively large loans. We do have 5 or 6 times in terms of, it's much more wide than if we use a syndicated loan, and it has the data set, and it has the advantage that banks could change the terms and conditions. It's a global borrower data set. The key, the paper is very, very simple. So we basically regress growth, lending growth for each quarter by the bank. So this is purely, think about it, lending. And then we have like a diff in diff in which what happened during the pandemic period for banks using IRB. And then we have a bunch of bank variables. There's a typo there because the bank variables are actually lagged. This is the second time we present this paper. And we verify the parallel trends assumption. So this is what we find in a nutshell. So in terms of quarterly data, banks lending to corporations, we call it NFCs, again, central bank lingo, but it's basically non-financial corporations, see that you have a big increase to a borrower merely from the fact that that bank is using his own model to measure credit risk. So a regulatory action has an actual impact on borrowers who probably need it the most. The second part we don't fully analyze, but I think it's interesting. Now, I'm going progressively, so the effect is actually increasing as I'm explaining it. This decline in lending also happened to be the largest for on-balance sheet exposure. In particular, for loans. So it is loans to non-financial corporations. So the economic impact is actually increasing, and it's already relatively large. So the second and last part of the paper, we do exactly the same framework at the borrower level. So we focus on those firms who happen to be lending for IRB banks using internal models for corporate credit risk, and for banks using the standardized approach. And we see whether borrowers having more lending from IRB banks, again, banks who calculate their own credit risk, are subject to less lending because of a supply constraint than banks who use a standardized approach. So it's a multi-bank firm, so we focus only on multi-bank firms and we compare both of them. So what we see is that the reduction, and if you look at the magnitudes, actually, what you would call the intensive lending, we see that the magnitudes actually increase when you look at the loans and securities at the borrower level. So we have, if you look at columns 3 and 6, we are able to put firm time fixed effects and therefore account for a relatively wide, the cap of the fixed effect is suctioning the within impact at the borrower level. To a large extent, we could attribute this to supply effects. We use a bunch of different things, so I'm going to show you 3 of them. The first thing we do is, well, but IRB banks and non-IRB banks might be different, which is a point that is similar to the point that Daniel was raising before. You might be lending according to your technology, Stein. So 2 answers to that. The first one is we actually have banks who actually flip, what we call the flippers, like banks who were forced. The ECB did a big standardized, we have a problem, so we need to standardize the models. So we use those. But we don't have too many observations. It's only 2 banks who did that. So we also look at within IRB banks. And we say, okay, let's look at banks who have low and high capitalized. And we see that the decline is stronger for IRB banks, banks who create their own models, measure, use their own models to calculate. And you see that the decline is stronger for those models. And even stronger when you take into account the firm's time fixed effects. Undercapitalized banks using an IRB approach, using their own models, decrease their lending by most. So the last thing that I wanted to tell you is, do IRB banks reduce lending to those borrowers absorbing more capital? And the answer is yes. We have individual measure of credit risk mitigation, so we know how much capital an individual borrower is making. Do IRB banks reduce the lending to those more affected sectors? So in Spain would be the tourism industry, for instance. So yes. Do you see a difference between foreign and domestic borrowers? You might have more information on domestic borrowers than foreign borrowers, and the answer is no. So this is what we see. It is not also because of long commitments, But we see that the decline in loans and securities, the increase in the decline is higher for those IRB banks with less capital. So to conclude in good time, so the empirical evidence that is that IRB banks constrain lending during crisis periods when borrowers need it the most. So this is very much in line with what, if you go back to the 90s, the majority of policymakers would tell you that, look, banks are great at actually, I could hire a nuclear science, a physics, somebody doing physics, and they would be great doing the value at risk models, and they would know much better than actually a supervisor. Well, it turns out that might be the case, but from a borrower's perspective, from a welfare perspective, might not be the case. We see that IRB banks lend less to the same borrower during COVID, and we needed an exogenous shock to do this. The supervisory assessment might be exacerbating cyclicality under extreme events. Okay, so if we want to have a normative suggestion, the answer is don't focus so much on bank capital, don't put all your eggs on the bank capital nest, but something more realistic is it provides empirical support for the implementation of a floor for the output of internal models. At least give me a floor. So the Basel, you call it as you wish, 3.5 or 4, to be implemented to 2027 as a backstop to reduce the excessive variability of risk-weighted assets and to make the risk-weighted capital more comparable. I know this is a debatable issue, but our paper seems to be supporting this floor. Thank you so much.
Okay, thank you. And now we move to the discussion. So we wait to get the slide up. So the discussion is Saleem Bahaj.
Yeah, thank you.
Formerly at the Bank of England, now at UCL.
Thanks. Okay, so thanks very much for the invitation to discuss this very interesting paper. Thanks for the presentation, David. I enjoyed hearing it and reading the paper. So this is, I think, actually a very simple idea, which is quite easy to show with a few equations. So imagine we have a situation where there's two banks. One's an IRB bank and one's a standard approach bank that lends to the same firm and they're otherwise identical. The capital requirement on the standard approach bank has a risk weight which is kind of fixed, although it does depend on external ratings, like credit ratings, which you kind of brush over, but that aspect is assumed to be relatively small compared to the IRB banks, where their own models will drive the risk weight. Okay, so you have some business cycle shock, which I called Z here. The risk weight will move from the IRB bank and not move with the standard approach bank. Okay, so that's the basic idea. There's some cyclicality in the IRB banks, and that sort of lends itself to a different diff. So you want to understand the differential effect of this cyclicality. If those two banks are elsewise identical, the differential response to this business cycle shock will get you the effect of this procyclical regulation. Okay, that's the idea behind the paper in a couple of equations. I also want to make the point that it's a test of both procyclicality of regulation, but also whether the requirements are binding. Okay, so we're doing both things at once here with this sort of regression. Right? You need requirements to be binding for this effect to be taking hold, and you also need to be binding to the same extent for both types of banks as well. Okay, so in terms of the setting, I mean, David explained it very well. We're looking at Euro banks during the COVID pandemic, supervisory data, and the loan level information is from the large exposure declaration. So we're looking at very, very large loans, or relatively large loans from the individual banks. And at the bank level, we see a sort of 2% cut in lending for IRB banks compared to SA banks, and that increases by a factor of 4 when you look within loan. And I'll come back to that in a couple of slides. Okay, so there are a few identification challenges to getting these results, and that's really what I'm going to pick up on in this discussion, as you would imagine. The first is that, and Dave talked about this, banks can drive business cycles, and that's sort of why we want pandemic lending. We have a nice exogenous shock here, not related to banks at all, unanticipated to a large extent. I think actually that's the neatest part of the paper, the setting and the marginal contribution. The other issue, obviously, is we have this demand and supply separation, which is standard in these sorts of problems. You look at the borrower, Dave goes for a Khwaja-Mian sort of classic approach, and I'll discuss a little bit how that can cause problems, I think, in this setting. And lastly, we have, I think, the big issue that banks select themselves whether they use an IRB or an SA approach, and how do you really deal with that, and how do you make sure there's not a bunch of other competing stories generating that selection. So that's the first thing I wanted to talk about. I mean, you can tell the same thing that Daniel did about different technologies, but also you can talk about, just a different business model in general, different supervisories treatment, different funding model. All these things are different amongst IRB versus SA banks, okay? And I've just put the chart from David's, or the table from David's paper, just showing just across these 5 different dimensions how the two types of banks differ. So, IRB banks are 300 log or 3 log points difference, for instance. There's a big difference in size. What's interesting is I think the closest paper in literature to yours or to David's is this paper by Benatar in the JF. And what they do is they look for banks that are transitioning from IRB to SA. They have sort of portfolios within the same institution that haven't been fully treated yet. Okay, so they have randomness due to an incomplete transition, and that basically gets the identification. And so, again, so given that you have a paper out there which is doing a similar study, but deals with this selection problem, I want to know what sort of marginal contribution. And my take really is, they look at the global financial crisis, you're looking at COVID, and that's a cleaner shock. So that's something you could think about, but is there another contribution relative for them that you wanted to bring out from your work? In this setting, I mean, there isn't a huge amount you can do, to be honest. You could match, you could include many, many more controls and polynomials and all sorts of things. I mean, I think you should do that. It would probably make the results more convincing. One suggestion I had, based on what you already do, is to look at this well-capitalized versus low-capitalized banks, but also comparing IRB and SA banks within those two groups. Because what you're testing there is whether banks, that are undercapitalized react more to the shock, which I guess actually we're going to see in the next presentation. But your prediction is that IRB banks that are undercapitalized should react more than SA banks. So having that extra diff may get you some power. The second thing I want to talk about was this large exposures data set, which I think is an interesting thing to use. But then there's a few questions I had. The first was, are these really representative? We sort of know these are key relationships for the banks in question, and relationship banking seems to work to ensure borrowers in crises. So are we actually underestimating the effects due to large exposures data? And there's other differences in banking centers as well you can talk about. And there's also an issue of censoring potentially if borrowers leave the data. And there's also a technical issue regarding the IRB scheme, which is that, as I understand it at least, there's a difference in IRB treatment between large and small borrowers. And so smaller borrowers actually have a systematically different treatment in the regulatory regime regarding IRB. And they actually have a much richer set of models of small borrowers, which I guess would make them even more procyclical. So maybe large exposures is missing out quite a big channel here. And the third thing, which I really, really wanted to see but wasn't in the paper, was, can you not measure some proxy for the risk weights and just show us that IRB banks are raising their risk weights relative to SA banks? And that's definitely feasible at the bank level because you do have the average risk weight. Last sort of main comment was this with the Khwaja-Mian estimator. So, I mean, one thing that the Benatar paper mentions is endogenous matching, which is that banks actually choose their borrowers based on their ratings model. So, if I have a borrower, I actually give them a high rating, I'm going to match with them, and that'll be a large exposure. And that sort of generates this problem. I want to know, could you deal with that in some way in your setting? More generally, with the quasi-Mian estimator, the problem is that the sut-var assumption in different diffs is violated, right? So within a borrower, SA and IRB banks are substitutes or plenty of complements to each other. So there's a nice paper by Bergetal showing this and actually discussing ways you can address this. And this means you may actually overestimate the total response because the two borrowers substitute for each other. And that may explain why you get 4 times the effect at the borrower level than you do at the level of the bank. And lastly, just to plug my own work, we have a little discussion in there about how actually you look at the bank level versus the loan level can miss a lot of the effects that occur at the bank level when it comes to capital requirement changes. So it's something just to look at. I'll conclude. I have a bunch of other... How am I doing for time? I guess I have 1 minute left.
No, you have 2.
I have 2. Okay, so I probably can make it through the slide, given I have 2 minutes left. So this is just a bunch of more minor comments. So is there an explanation for different effects by loan type? So why do we see NFC loan responding? Are their risk weights more sensitive to the cycle compared to other types of loans? There's this weird feature in the paper where you use capital times post as a control, but actually it's low cap times post that actually matters in the regressions. So you probably want to do low cap time post throughout. The collapsing is a standard comment for different diffs. I think actually the rest of things we can discuss offline. They're more minor comments for the paper. Okay, so let me conclude here and say it's a very interesting paper. I enjoyed reading it, and thank you very much.
Okay, so thank you, Saleem. David, you want to quickly respond to comments?
Thanks a lot for the very thoughtful comments. I think. So yes, there are a couple of papers. There's a paper by Rainer Hasselmann and I believe Bikram Big and Ben that they look, in fact, at whether I mentioned on the presentation whether a given borrower have more or less weights according to whether you are IRB and non-IRB, and also there's another paper that does something similar by Joao Santos and co-authors in the case of the US. And I think both of them are super interesting. The thing is, for us, the key thing is like, look, when it matters, which is like a big crisis, this IRB business has, and this is the reason I show you the banking data first. I agree with your last comment as well, no? Like, look, when push comes to shove, what happened in terms of the lending, and the impact seems to be very, very big in that sense. We do have, I mentioned before, what we call flippers. No, we have some banks who were forced to move from standardized to IRB, and vice versa for supervisory reasons, and we have something called TRIM, which is a massive exercise that the ECB has done. They have a whole division looking at this, trying to standardize, and linked to this, you also have capital shocks before the COVID shock that we could use in terms of identification as well, and we'll probably do to make it maybe more refined. Thank you so much, Saleem.
Okay, so in the first row we have lots of questions, starting with the first row.
Thank you. I have a question on this identification issue again. Now, you are really looking at IRB versus standardized approach, and let this be the outstanding characteristic that drives your interpretation. There may be other differences that you are not accounting for that may give the same explanation. And one that is has been indirectly mentioned by Saleem is the fact whether you have a relationship bank or a transactional bank. And of course, there's some literature that shows in a crisis, in a sudden crisis, relationship banks increase their lending while transactional banks decrease their lending. So unless this is somehow the same as IRB and SA, then the interpretation may also be different. So my take would be IRB banks are typically large banks with many transactional relationships. And so in your data set, the majority of IRB may be transactional. That's why it goes down in the crisis and so forth. So that would be another interpretation which doesn't resort to the model-based.
Yeah. So this is the reason we also show. Oh, sorry.
No.
Okay.
Go ahead.
So this is the reason we also It's not only perfectly possible, we see that this is also happening on the data. So I tried to show like a very initial results that we have. But apart from balancing the different characteristics of the bank, we also have like a within IRB banks. So within IRB banks, we have the assessment of the supervisors as to how cyclical a certain modeling is. And within that, we could also see whether the fact that you have using your models in a more cyclicality way, and we ask the supervisors exactly that question, whether that is leading to the fact that when you have problems, the cyclicality increase. It's only survey data, so we classify the banks, the IRB banks, into 4 categories. So this is like a dummy, but we also do that on top of the bank part. But I agree, it's a very good angle as well.
Okay, Jose.
Thank you, David, for such an interesting paper. I have a couple of questions, and I think the first one is going to be a little bit of an unfair question. I also struggle with this question, having done research on the impact of regulation on bank lending. So, it seems to be that indeed IRB banks cut lending more than their SA counterparts. And you argue that this might be an unintended consequence of regulation. But I'm struggling to see whether that is indeed the case. Sometimes, indeed, regulators tend to overdo the role, and it might be highly costly for firms borrowing from these banks. But is it the case that maybe, as has been argued, some of these RB banks might be indeed more risky, and regulation try to make them lend less or do less risk-taking? And the second question related to that is there a possibility that the firms that borrow from these banks and might be struggling to get the credit from these banks are indeed not able to substitute and therefore affect their, the real operations? Have you tried to look at potential real effects or real consequences?
No. So yeah. So the answer is so. I think IRB banks are clearly, from the result that we have, more cyclical. Also within IRB banks, we have not looked at the real consequences like you do on your paper, but I think it's interesting. And also something we haven't done, which I think is very interesting, is that, look, I'm telling you that we are cutting credit, but what's the quality of the credit that you are given? Because indeed, are you cutting off? So the only thing we've done in that direction is looking at more affected sectors by the crisis. So you might argue that hotels in Spain might be profitable because they've been profitable for the last 20 years. And if you cut them off, you might be not able to survive. But that's all I can say about that.
Okay. Javier Suarez.
Thank you very much. Javier Suarez from CEMFI. Thank you for the presentation. You are touching on a topic which is very close to my heart. And my previous research, I very much also sympathize with advising against the potential procyclicality of regulation. But let me now play the devil's advocate role. so to make the following point, maybe precisely, and I think it's in line with what Jose Berrospide was mentioning, maybe the idea of the internal ratings-based approach is to be risk-based. So when the risk is rising, the capital requirements should be higher, and as a reaction, some of the loans will be repriced and maybe not given. So I wonder, perhaps, on the normative reading that you want to give to the results. To me, it's not obvious. I mean, you document that. Maybe other things equal, with the standardized approach you will be giving this credit, with the IRB approach you are not, but maybe this is exactly intended. Or, on the other hand, I mean, regulation should be there to work well, I guess, on average. Now, this is a very specific shock of a very exogenous nature in which perhaps we will have like credit to grow all over the place, and then in this sense the unintended is better. better justified. So I would just like to sort of put those caveats to the analysis that is, on the other hand, very informative. One other point, I see sometimes people being critical on internal ratings-based approach with potentially contradictory arguments. So one view is it creates procyclicality, and this seems to be the hypothesis in your work. But then another view is, and because it's internal models, there can be a lot of manipulation. If there could be a lot of manipulations, these banks will manage to manipulate their models to keep lending despite the shock, and it's not the case. So one of the two stories somehow is to be sort of contradicted by the evidence. On the other hand, and finally, I agree with the discussion on when a borrower has access also to banks using the standardized approach, the effects will be stronger, because indeed I believe in the loan pricing implications of the capital cost in the background, right? So if for the standardized approach bank, the cost of capital has not increased for that particular borrower, that bank will be in better position to offer the lending and absorb the lending. So I think all this can be put into the perspective of your analysis without really questioning the underlying findings. Thank you.
Okay. You can reply, and then we will have the final two questions. Yes.
Okay. So, the first point is that, it might be, in a way, I think your question deep down is like, look, in a period of crisis, forbearance might be appropriate. So you might want to have low capital to keep credit flowing, which goes back to the issue of the quality of credit. So you might have less credit, but you might want to have less credit of better quality, right? And it's possible. All the evidence that I show you suggests is not the case. But it's possible to have done the analysis. Let's go back to your first question. Now, regarding your second question, the answer I have, it's a very practical one. So I started reading the literature that you contributed to as well, this paper I mentioned, but it's been circulating for a long time. Because when there was the big deregulation, putting things in perspective, late 80s, early 90s, massive deregulation of the banking sector. So clever people like yourself started looking at banking competition and risk-taking, or the issue of cyclicality, right? So this is a big issue that was never taken into consideration by policymakers, in fairness, after we have an actual crisis. And then the papers started to come in along and things like this one. Now, my question is much more practical. Within a bank, the guy doing risk management makes, in the big banks, 200, 150,000. The guys taking the risk on the syndication desk make 3, 4, 5 more times that money. So effectively, the political power of these people, and effectively when you talk to supervisors and you talk to people doing the modeling of the banks themselves, you realize that the political power within the bank, internal capital markets, is relatively small. So it's a mixture of, I don't think they really know, in fairness, what are they doing in all the stages of the world, which is what we supervisors or central bankers want to think about. It's very difficult. It's too tall an order. And the second thing is, it's very difficult for somebody to say to the CEO, look, you're going to make less money over the last 5 to 10 years, which is what the typical credit cycle takes. Which of the two reasons is like either you are not very good at modeling, or you wanted to make, it's difficult you wanted to minimize the cost of equity. I think it's probably both. And I think both are complementary in terms of the science that we find on our regression.
Arun.
So my question is in line with the discussant and Javier, but is to some extent general to the application of diff and diff models in finance. So we have imported the technology from labor, and in labor it is usually applied to univariate problems. So one exogenous variable, one endogenous. But in finance, we typically deal with multidimensional issues. So the logical application should have been to look at all the endogenous and how they respond to the shock. So in this case, one endogenous which is just crying out loud is the credit default swaps of the bank. If it is unintended consequences of these initial model-based lending, I would expect to see a widening of credit default swaps of the model-based banks during the crisis. This is one endogenous that I thought about, but there might be more. And Jan's point about relationship or non-relationship is another one. So I think that if it's okay to take the philosophy of reduced form econometrics from labor, but there's no reason to take the univariate approach. Let's look at all the endogenous and how they respond, and that would allow us to have much more informed inferences from the evidence from the reduced forms that we estimate.
I think it's a very good point. We could do that, yeah.
Okay, last question, Elu Fontaden, here in the first row.
Thank you. Basically had the same question as Javier. Let me rephrase it a little bit, because in the typical way you're thinking about these IRB models is that you give these banks the possibility to use their inside information to assess risks better and allow them to calibrate the associated equity requirements better, but at the downside of giving them the leeway of manipulating them. I mean, just put it very, very bluntly. And so in that sense, when it looks at that trade-off, what you're finding seems to be going into, is to me not fully conclusive. You could argue that indeed we see in a large crisis where risks really are becoming much more important, these banks do the right thing because now they are using the information they have about the different borrowers they are potentially lending to, and they are reducing borrowing. On the other hand, they may exaggerate this, and then you get into this to their own benefit or to their own political whatever audience, and then you get into the cyclicality issue. Is there any way of discriminating between these two, let's say, potential problems with IRB? I guess you have answered that question before here to Javier, but maybe I didn't fully get the point, because of course we're all thinking about identification issues and how can you compare IRB and SA and Bain et al. But I mean, my question is much more simple in a sense.
Yeah, so I don't think it's simple at all, because effectively what you are trying to say is that, look, are these banks better or worse at deciding whether a borrower is solvent in March, in June, which is the logic that ICO in Spain were doing when shifting liquidity into the firms, no? Truth is, it's possible that what we find that these banks declining lending so much to certain borrowers, they knew and they were doing a much better job. It doesn't seem to be the case by the reduction in the sectors to which they reduce the lending to, but it's a part of the analysis that we haven't fully done, so it's a point well taken.
Okay, well, thank you, David and Saleem. And we now move to the last paper of this session. So Arun, can you come forward to the podium? And the discussant is Andrea Polo, who is in Rome. So he will use the Zoom facility to present his comments.
Okay, thank you everyone for providing us with this opportunity to present and receive feedback. So this is a paper that my colleagues at the Federal Reserve Board, Jose Beraspide, myself, Arun Gupta, and Matthew C. have worked on. So we're basically looking at empirical tests of whether or not Basel III regulatory capital buffers were in fact usable during this recent recession or crisis. So a little bit of background here, and I think very nice setup by the keynote speeches touching on this issue. So Basel III introduced regulatory capital buffers such as the capital conservation buffer, CCYB, GSIB surcharge, which are regions of capital that sit above minimum requirements and which are a new feature of the post-crisis regulatory reform. So these buffers are actually intended to absorb bank losses in times of stress and help support the economy by maintaining the flow of credit during a downturn. And so they're typically costly to use so as to incentivize maintaining a buffer for kind of a rainy day fund to be used in a scenario such as the pandemic. However, the intention is that when the pandemic actually arrives, that this would now be used for these purposes. So I think some of the, one of the motivations that we were kind of looking at is that it looks like buffers were very effective in incentivizing banks to raise their capital during the pre-pandemic period. So during good times, effectively raising their capital ratios about 2x compared to 2008. And so our research question then becomes, were these buffers in fact usable during the downturn? So testing the usability of these buffers in a downturn. And if not, did the unusability in fact lead to credit supply shocks, particularly on the margin to small and medium-sized businesses? So, if you take a step back and look at the broader metrics for the banking sector in the United States, so, despite the pandemic, CET1 ratios remained high and have actually risen above pre-pandemic levels. So, it appears that, capital management at banks was quite quick to replenish the size of this cushion or headroom above regulatory buffer thresholds. So in 2019, they were roughly about 12%, and they've in fact increased faster since then. And so, I want to be very clear that the pandemic was first and foremost a loan demand shock. However, we're more interested in looking then whether there was a feedback effect through the inability of banks to actually use these buffers, by which they might actually start to constrain lending on the margin to small and medium-sized businesses. So there's been a lot of motivation for this paper, particularly from the financial press and around the world through many central banks. So in particular, the chair of the ECB's single supervision mechanism had mentioned that there's been a concern that buffers are not being used and that there was a reluctance to use them. The ECB's financial stability review has shown evidence empirically kind of consistent with this concern. The IMF has also put out similar concerns in their recent 2020 financial stability report. And many credit rating agencies have actually questioned this as well. S&P Global saying that questions have arisen over the bank's ability and willingness to use these buffers. And with the concern that banks might react with a kind of pro-cyclical response. So we start off with the fact that none of the US bank holding companies have in fact drawn down and dipped into these regulatory buffers, such as the capital conservation buffer, GSIB surcharge. So we then look to examine what are the lending implications potentially of a reluctance to use these buffers. We're interested in understanding if they are unusable, where does the costliness derive from? Is it a market stigma concern? Is it a regulatory uncertainty as to if you were to release these buffers? There was actually, I think, in Europe, particularly with the release of the Pillar 2 guidance, there was several articles saying that I think only 9 banks out of the 160 supervised institutions ended up using their buffers. And so then it becomes an interesting question to try to understand that. So we'll be looking at a very simple kind of framework, dividing banks and using a simple diff and diff to look at banks that entered the pandemic with capital ratios relatively close to the regulatory capital threshold, call those buffer constrained, versus banks that entered with larger cushions, and trying to control for borrower characteristics using different kind of firm groups. So putting our results kind of at the front, relative to buffer unconstrained banks, we find that buffer constrained banks reduce C&I loan commitments to SMEs by about 5.6 percentage points more during the pandemic. We find a similar result, 4.8 percentage points more curtailing of credit to young relationship firms based on the age of the lending relationship. And another interesting kind of test that we try to run is we divide firms into groups based on if they had a credit line before the pandemic with that basically matured right at the start of the pandemic, that would be plausibly exogenous to the pandemic, obviously, since that was an exogenous shock. And so we would then expect that if this story were in fact true, that banks who are looking to potentially curtail credit, they would find it much less costly to cut to a firm that has to renegotiate at one of the worst times possible. And so it would be contractually far less costly to cut credit to these firms. So we find that these firms, the ones whose pre-pandemic credit lines matured during the pandemic, lost about 9.2 percentage points more in total commitments. And then on the extensive margin, we find that banks that were constrained by these buffers were in fact 5% more likely to terminate lending relationships with SMEs, with similar results for the other firm groupings. And so it's much more difficult to then try to ask, now if this story is true, what is it about these regulatory buffers that make them expensive to use? So we'll try to run a few event studies to try to get a sense of the costliness of the various proposed concerns about the usability of capital buffers. So I'd like to also just emphasize that this is actually more than just SMEs that we're talking about here. It's basically, if you are not, as a bank, if you do not want to draw down on your capital buffers in order to continue lending, out of the set of your clients, which are the firms that you would be most likely to curtail credit to, it's those that are relatively cheapest to do so. So, if you're an SME as opposed to a large public conglomerate, we would think that you would likely to cut to SMEs, a lot of them, mainly because you don't want to lose the relationship value that you've built with some of these larger firms who might have multi-line products at these banks. Similarly, if you have relatively not invested a lot in terms of getting a relationship value by looking at the age of the relationship. And then finally, if we look at whether, if it's contractually less costly to cut to a particular firm based on their renegotiation date. So just to give a visual, so you imagine a bank that's sitting at the pre-pandemic at about 12% CET1 capital. So the capital is basically divided into three regions: the minimums, which lead to insolvency, these regulatory buffers, the GSIB surcharge, CCYB, and then their headroom, which is the green. So we consider this middle portion to be the new Basel III framework, and it's relatively costly. It comes with payout restrictions on dividends, bonus restrictions, market stigma potentially. So pandemic arrives, banks start taking on losses. Now the idea here is that regulators would like these banks to use this blue region in order to continue lending to creditworthy borrowers. However, the bank has their own decision node where they could potentially delever and curtail the availability of credit to avoid incurring the costs associated with these buffers. So in that way, they may be treating these regulatory buffers as de facto minimums, in which case the question then becomes, are these buffers kind of a harder than we thought requirement as opposed to a soft requirement the way that they were designed in Basel III? So the data that we have is the closest thing to a credit registry that the U.S. currently has, Y14 data. It has loan level information on credit lines as well as utilized amounts, 50,000 borrowing firms, both public and private. And one thing is we look at loan commitments which are immune to drawdowns. So the issue of these precautionary liquidity drawdowns are not going to be impacting our Y variable here. So again, the strategy here is to divide banks into two groups based on whether or not they had a lot of headroom above their regulatory buffer thresholds, and try to group firms into similar groups. Ideally, we would have liked to use a Quadjamian type of estimation. However, because the majority of our results are associated with SMEs, they typically only have one lender. So the next closest thing we can do is to try to group them by location, date, industry date, size date, and so we'll include those. So just giving some visuals here, if you were to look at the total amount of SMEs that were borrowing at these two groups of banks, you see that if you were buffer constrained, you see interesting 3,000 firms during the pandemic in the United States basically falling out of the sample, implying that a large percentage of this could be in fact terminations of loan relationships. And so what's interesting also is that a lot of these are not ending up in the PPP program. And I think one of the reasons potentially is that the size of the PPP loans that you could receive are typically much smaller than the size of their Y14 loan commitments. So substitution becomes not very viable in terms of maintaining your credit. If you look at the intensive margin in the cross-section, if you were to rank banks by their capital headroom, which is the x-axis here, versus their performance in terms of lending growth during the pandemic, you see that banks that had relatively lower headroom ended up lending far less than those that were buffer unconstrained to the right-hand side. And then in the time series, you'll also see that once the pandemic arrives, you see that there is much slower credit growth for firms borrowing from these buffer-constrained banks. So just a very simple diff and diff kind of specification here. We'll be looking at pre and post the pandemic period, whether or not you were a buffer-constrained bank. We basically take the median of the distribution of the capital headroom, and we label you as being buffer-constrained if you were below the median. We also have results using a continuous measure, but however, for the interest of time, I'll just stick to a very simple framework. And then we'll also look as to firm heterogeneity by looking at these three types of firm splits: SMEs, young relationships, and whether or not a firm had the unfortunate occurrence of having to renegotiate at the worst time possible. So summarizing a series of tables basically in just a few slides. Here you see that if you were an SME that was borrowing from a buffer constrained bank, you end up seeing 5.6 percentage points lower credit growth as compared to a similar SME borrowing from a buffer unconstrained bank. And so these would be grouped based on location, date, NAICS, or industry date, as well as size buckets in the fixed effects. And similarly, if you were a relatively young relationship firm borrowing from a buffer-constrained bank, you're going to see about 4.8 percentage points slower commitment growth during the pandemic as compared to a similar young relationship firm borrowing from a bank with a lot of headroom. And then finally, if you're a firm that had to renegotiate during the pandemic, then it's actually a much higher effect of about 9.2 percentage points. On the extensive margin, we can look to see whether or not you exit the sample as a firm, typically meaning that either your relationship has basically been terminated. So in this case, if you're an SME that borrows from a buffer-constrained bank, you're 4.6% more likely to no longer have that relationship during the pandemic. If you're a young relationship firm, roughly 1% more likely to no longer have that lending relationship. And then finally, if you're a firm that has to renegotiate during the pandemic, then you're about 3% more likely to have your lending relationship terminated. So with the few minutes I have left, we also wanted to try to say something about now if these results are indicative of the lack of usability, why are these banks finding these buffers so costly? And there's been many reasons that have been hypothesized. One is that credit rating agencies potentially have been putting pressure on banks to not use these buffers, kind of against the ideals of what regulators would have liked. And so, for example, Moody's actually put out an explicit statement during the pandemic that banks are expected to maintain capital levels above the pre-pandemic numbers, basically implying that if you use your buffers, that might be a signal to us of weakness and you would be risking a downgrade. And then finally, there are payout restrictions, so therefore there's market stigma concerns as to how the stock price might behave. And then finally, one aspect that has been quite talked about a lot is there's an uncertainty with regards to releasing capital buffers, in that if I release, let's say, the G-SIB surcharge, or as a bank, I don't know if you're going to reinstate it after 6 months, 1 year, 2 years, so then maybe it's not optimal for me to even go through the roller coaster ride of allowing my capital to fall and then having to replenish it 1 year from now when I don't know what the cost of my equity capital will be. So we can basically use a quick event study analysis from 2008 to try to get a sense of two of these channels to see were they costly. Unfortunately, because the pandemic, you don't really find US banks using these buffers. It becomes difficult to estimate that during the current crisis. So we basically find that, for banks in 2008 who experienced a credit rating downgrade, their stock price fell about 2.6 percentage points over a 3-day span of normal return. And then for banks that were forced to cut their dividends, that was about 2.8% cumulative of normal return during 2008. So both of these suggest that these are very costly actions and that they may be associated with the usability of capital buffers. So finally, my conclusion slide here is that I think a takeaway that we have been thinking about is that our buffers somewhat of a double-edged regulatory sword, in the sense that they were extremely effective in having banks, getting them to raise their CET1 capital in the pre-pandemic period. There have been several papers that have shown evidence of this. And why would that happen is because they must be costly, otherwise you wouldn't really care. But it's that same costliness that affects you in the downturn, because these banks basically don't want to use this buffer, so therefore they might be incentivized to curtail credit to potentially credit-worthy borrowers in order to avoid all these costs. So in that way, the concern then becomes, does this lack of usability potentially lead banks to treat these regulatory buffers potentially as new de facto minimums, something like a 10% minimum requirement in quotes. So with that, I'd like to thank everyone, and I look forward to discussion and questions.
Okay, well, thank you, Arun. So let's see if we can bring Andrea, Polo to the floor in the online world. Oh, wonderful. I can see you. Now we only need to see your slides.
Okay. Can you hear me? Yes.
Yes, but okay.
Can
good.
you hear me?
Yep. Good.
Very good. So thank you very much for the organizer, and let me reiterate my apologies to the organizer and to all of you who are presented there in Madrid, because at the very last minute I couldn't make it due to family reasons. I would have loved to be for the first time in an in-person conference and there with you. Some of the things that I will say kind of already emerged. Some of the tensions that I see in the exercise already kind of emerged in the speeches that we had this morning from the initial remarks, and in a couple of questions by Rafa and Dorian. Okay, so what is the story? So as we know, banks entered the crisis with much higher capital. In the US, it was double than the previous recession. Large part of this increase in capital was due to this requirement, to these regulatory buffers introduced by the Basel reforms, which banks can use to absorb losses subject to some restrictions. Now, is the approach sound? Does it make sense to have these buffers on top of the minimum that banks can dip into when a crisis comes, or it's not just better to have higher requirements with it? When a shock comes, will banks, in this framework, keep lending or not? So COVID-19 comes, great, now we can test this approach. Now, is it too early to say? This is kind of one thing that emerged this morning from both the speeches of the remarks. So this is so this graph shows 242 banks international, and this shows this capital headroom. So this capital on top of the required plus the buffers, right? So it's the capital headroom, so they're really the free one. So the one is excess, truly excess capital. And you see that the banks seems to have a lot of these. Okay? So most of the capital ratio were well above the required minimums, and so this makes it be difficult to assess whether banks would be willing to use the buffers, right? This is the view of the Basel Committee, I guess, and also of Andrea and Ria from the European supervisor. So the Basel Committee say fear of imminently breaching the buffers is unlikely to have been a key consideration for most banks during the pandemic. And Andrea and Ria say, well, I think it would be premature, in my opinion, to see the fact that they are not using the buffers as an indictment of this framework, since because they had a lot of them, a lot of these buffers. Okay, I think so. Andrea and Ria said we need to wait until larger losses will be materialized once maybe these large, massive support measures will be with. So if this is a graph from the nice paper of Camelia that you have just seen before. Now, in the US, what are the reasons for tightening of lending standards? And you see on capital position, it doesn't come as a super relevant factor for tightening of lending standards, as Camelia explained to us. Okay. Now that said, some banks enter with the shock with less capital headroom, and some banks with more. Okay. So the idea is, if I put in the regression this variable, and if I see that banks with less reduce lending relatively to the one which have a bit more, this could be interpreted as a reluctance to make use of the buffers. Okay? So this is what the paper is about. 16 large banks in the US, very nice granular loan level data. This is for loans which are kind of relatively big in a sense, no? Larger than 1 million. For instance, the unaccredited in Europe would be 25,000 euros. But anyway, so it's a diff in diff around COVID-19, and alla Quagemiana in the sense that they will control somehow for credit demand. Okay? So the findings that banks with less capital headroom will reduce lending and more likely to cut relationship, in particular to private bank-dependent firms, young relationship firms whose credit lines are up for negotiation. So I was following this debate, and I realized that there are, as Arun said, there are similar results from different samples. Okay? So the BIS, in the study that was mentioned in the morning, in their study, they report evidence from the international banks with a similar result. There is evidence from euro area, from the Financial Stability Review. There's also evidence for UK banks. This is mentioned by the supported member of the board in a speech, in a recent speech. Okay. Now, so when I read this, when I was reading it, okay, it must be a test about capital. No, in a sense, okay, so do banks which enter more capital lend relatively more during a shock? Which is not an obvious question. It's not an obvious question because, yes, it was the case in the previous crisis. For instance, at the Banco de España, there is this very nice paper on the ER no, showing that banks with less capital lend less during a shock. But it's not clear in this one. So we have seen We've seen the paper of Camelia, we've seen the previous paper by David, there is another paper by Strahan, and capital doesn't seem to be really important. But hold on, because then I jumped into footnote 12, which says this relationship cannot be explained by capital. Counter to intuition, excess capital cushions are not positively correlated with capital. Now I stop for a second and I ask myself, how is that possible? Well, it is possible because, as Arun very well was telling us, so capital will be the old bar, right? So the CET1 ratio will be the old bar. Then I thought, okay, so the green part, of course, will be symmetrically 1-to-1 to capital, right? Because this is 10%. No, but the trick part is that the blue bar is different bank from bank. Okay? Because basically the regulator in the US will ask you more of this blue bar if you are more systemic, and will ask more of this blue bar if you did not perform well in the stress test. Okay? So this blue bar change, this creates this disconnect between the old bar and the green one. Okay. So, but it's not just that there is no correlation, but they show in the appendix the correlation is negative. So, which is very interesting. So it's telling us that the higher the regulator asks the bank to hold capital, the lowest is the amount the banks hold in excess of it. Results in the paper just by visual inspection seems to be the opposite if you use capital instead of capital headroom, exactly because of this negative correlation that the authors carefully showed. So, okay, so first of all, it's super interesting. Now, of course, we need to control for this. Now, these are type of regression that they run, so we want to make sure these buffer constraint banks, we are not capturing this negative correlation with capital. So the authors control, you see, control for these variables, but I think it would be nice to control, we need to control for the interaction with post, capital times post, and see what happened to the results, because then you say, if we keep capital at the same level, then what is the impact of having more or less excess cash? And probably here also, key ones, by listening to previous papers, other key ones to control for in the post times characteristic would be size. Daniel told us, Daniel, that size is related to many things in banks, so it's important for size, and probably because of the paper of Camelia for undrawn credit line exposure, we were told that that is a very important variable during the pandemic. Now, regarding control for demand, so the authors say we cannot include firm tactics effect because there are many single lender firms. They include these control, industry time, region, zip time, size time. And I think the spirit of these, the Grice et al. That they mentioned, is more possible to control to a kind of firm cluster. A firm which is, we want to compare firms which are in the same region or the similar size or a similar industry, which is more demanding than having the separate. So this, I think, would make more robust, as the Arun said, demand is most crucial in this type of shock. Now, let's go back for a second and think about the exercise and say, so as I mentioned in the previous slide, the reluctance to make use of the buffers is inferred from the cross-sectional heterogeneity between banks with more and banks with less. Now, the concern here is that think of the following situation. Let's say that all the banks, the median, let's say, is 15%, like a lot of excess capital. The word of an mathematic, a lot of capital. Now, in that world, let's say that still there is a median, there are banks with a bit more and a bit less of this median excess capital. Now, if you find that the one with more lend more than the one with less, would you conclude that the one with 14% are doing this because they don't want to dip into the buffers? So in general, if before the shock, the bank decide to hold more of this excess capital, then when the crisis hit, it's possible that it's just stronger, more bank lending, more capacity, and will lend relatively a bit more. So one approach I think the authors could do, or this type of test can do, is to show that this capital headroom variable effect is not monotonic. No? So, for instance, if you use dummy with different quantiles or different deciles of all these this variable distribution, then the ideal thing to show that that these other dummies, the dummies are not significant different between each other, but it's really the one in the bottom which is closer to the threshold which kick in. Okay, so this non-monotonic effect would reduce this type of concerns and attribute this even more convincingly, this result to this reluctance to deepen the buffer. In your case, since you have a small sample, you just can create 3 dummies for these 3 groups, and show that the first and second dummy are not significant, and the third one is really ideal, the one which kicks in. The other thing here is that since Camelia told us that there are these data on the loan survey and where you ask the banks and say, look, why are you tightening? I think it would be nice to see whether there will be additional evidence in your favor to show that the one which say that is capital concern, the one which matter the most for the tightening, is in fact correlated with banks with less capital.
Andrea, you should be concluding.
So as I said, there are different
Andrea,
similar tests conducted in several jurisdictions now. And the caveats that I mentioned here may apply to those as well. I think the authors should stress that their exercise relative to the others is relatively more meaningful. Why is it the case? Because the other jurisdictions took actions to reduce the stigma associated with deepening into buffers. Which actions? They were mentioned by Rafa and Lorian. So Rafa mentioned the countercyclical capital buffer. So the way to do it, if you don't want the stigma, is that what is the macro tool? Is the countercyclical capital buffer. It builds during the boom, and then when the crisis hits, you put it to 0. This is what France or the UK had, which the US did not have, so did not have this macro. Blanket restrictions of payout. Well, are you concerned that banks don't want to do it, don't want to dig because they don't want the dividend restriction? Well, restrict them to all of them. This is what the ECB, the Bank of England, did in May, while the US did only later on in June, and so which apply from Q3. Now we were told today that there could be rationale because it was in the US, it's more of a story of share buybacks. But for this issue of stigma, you really want the blanket restrictions very early on in the crisis. So I think I would use these arguments in favor of the authors to say, look, if you want to do this study, you need to do in the US because of these reasons. So in conclusion, I think given the variability of regulatory buffers banks are required to hold, I think it's interesting and important to use this distinction, as the authors do, between capital and capital headroom. And this negative correlation, I found it very interesting. Now, the question of usability of buffers is super important. We have seen in these two, in the remarks of the day. No? So we want, it's a test of Basel reform, we want to know about it. Now, there are some concern with this test. I think it's too early to say, or whether the cross-sectional heterogeneity is capturing exactly this reluctance. But in a sense, the paper offers important evidence to this debate. So, in particular, I think in a country where regulators did not react quickly to reduce the stigma of deepening into the buffers, which is, I think, nice for identification, maybe less for the country. So, I only made a few suggestions to hopefully strengthen the analysis at that. Thank you.
Okay, well, thank you, Andrea. One of the issues about this hybrid system is that you cannot stop the discussant when he's taking more time. So we are starting to eat on our coffee break, so let me collect questions from the audience before I give the floor to Arun to respond. Okay, so any questions? Yeah, okay, Marcos. Did you hear anything?
For the second question on the forward guidance, could you repeat that on the capital buffers?
Right. So one of the reasons that you empathize why
right.
Banks are afraid to dig in, and that's because they are afraid of future regulation.
Right.
So if there's some forward guidance in the future path of the buffers, right, then that would be able to mitigate some of this.
Correct. Okay, great.
Okay. Any other question? Javier.
Thank you for the presentation. I'd like to take the opportunity essentially to come to a terminological issue, usage of buffers. The buffers are there to absorb losses. So the main way they can be used is out of unfortunate developments. When you have losses to annotate, then you consume the buffers, you use the buffers. So that is a use that we probably like not to see. Okay. The second way of using is, instead of when there are losses and you annotate them against the existing buffers, you expand your assets without expanding your capital. I guess this is the use of the word usage that is intended here, no? So, but of course the banks with the buffers might just want to have them for precautionary reasons, waiting for these losses to come, and part of that was recognized in the presentation. So I just wanted to make a sort of comment on what is buffer usage mean. It looks like we have this waste by not using the capital, and it's not right. The capital function in terms of loss absorption is perfectly played by the quote-unquote unused buffers. Now, on the other hand, the fact that, as your evidence suggests, there are many banks with voluntary buffers on top of the regulatory buffers, maybe it makes a lot of sense, and Andrea was saying that the new credit is granted by those with the voluntary buffers first. So then the evidence of this event in which not all the existing voluntary excess capital was used in the system, not seeing use among the ones that will eat on their regulatory buffers, makes a lot of sense in terms of some equilibrium model, again, of loan pricing, taking into account the shadow cost of your capital resource. Just this comment.
Okay, and finally, David.
Hi, thanks a lot. So just one very quick question. Do you actually see that the banks that enter with higher voluntary capital actually end up with smaller in relation to the ones that entered with lower? So are they actually using in the second type of idea? So, or basically were they also in the end with higher buffer? Okay. Do you see a shrinkage of the difference? Because I guess that's what you want to point, but I didn't see in the slides.
Right.
Okay, now you have a lot of questions and little time. So
Right. How much time do I have?
5 minutes
5
most.
minutes. Okay. So I want to thank Andrea for these excellent comments, and as well as the audience for these questions. So I'm very glad that, so in the appendix of our paper, we do mention about the difference between total capital versus the voluntary part. And we were quite surprised to find this strong negative correlation, which generally most people think if there's higher headroom, it must be that you're just higher capitalized. So to kind of separate those two, basically what you're getting at is that if a bank with high voluntary buffers has low total capital, that basically means what's the complement is that your regulatory capital buffer, so there's a lot of terminology here, the size of your GSIB surcharge and your stress capital buffer in the United States, that would be the inverse. So that would be if you have large voluntary buffers, then you probably have a small GSIB surcharge and a small stress capital buffer, implying that you're probably a less risky bank. So then in that sense, what we've been trying to do, and so we're going to be releasing a revised version, but it has to go through kind of confidentiality checks, so we're still waiting on that. But what we've done there is we basically find measures of riskiness of the bank to try to show that this contraction in lending is not, in fact, can be explained by various measures of risk, whether it's CDS prices or stock market reaction to the pandemic in the cross-section of banks. And so that's kind of one note I just wanted to mention there about addressing that very important point. On the other side, you mentioned about forward guidance. So this actually came from an analysis by the IMF. And so that was kind of brought to our attention in one of their, I think it was the May 2020 Financial Stability Report, where they did some kind of very basic analysis, particularly for banks in Europe, saying that one of the concerns might be that you may not be incentivized to use it even if I release the buffer simply because of this uncertainty as to when it would have to be replenished. But unfortunately, it's been very hard to figure out some type of test with the US data because none of them even enter that region. And then also thank you to Javier about mentioning about this terminology. So yes, generally when you think about it's a ratio, so naturally either the numerator is falling or the denominator is increasing. We'll make sure to kind of mention that in the paper in our terminology. And the last point was regarding substitution. So I think there's a question about, well, it's the banks that have higher headroom that are not curtailing credit based on what our results suggest. And maybe that's obviously an intended thing. And so I agree that we're not saying it's necessarily unintended. But what we do find is, so we've been trying to look at real effects. Unfortunately, I don't have clearance to yet show those. But we have been finding that if you look at employment growth in the geography of the United States, and using this loan level data, if you were to then assign different counties with the exposure to a low buffer bank or a low voluntary buffer bank, we find that those counties actually exhibit lower employment growth during the pandemic, kind of a similar diff and diff kind of strategy. So suggesting that the firms that are let go by these low buffer banks are not able to substitute towards these higher buffer lenders. And so that's all the time I have, but I'd love to talk to any other unanswered questions during the break.
Okay, well, we've come to the end of this very interesting session. I've learned a lot. I would like to thank the presenters, the discussants, and the audience. And now we have a coffee break. Let's be here at 4:30 for the panel on central bank digital currencies and financial stability. So I'll see you in 20 minutes back here. Okay, thank you.